welcome. You're watching Business Today Television. I'm Sakshi Batra. As India heads into the Union Budget of 2026, amidst global uncertainties, tariff wars and pressures on growth, few voices really understand the fine print of the tax policy and the regulation better than many of us as well. In fact, today we are going to be putting the spotlight on finding out what could budget of 2026 be really coming in with. We are going to be having a very special guest joining in on this special edition, Mr. Mukesh Butani, the managing partner at BMR Legal, one of the country's foremost experts on tax law, fiscal policy and regulatory frameworks that we know of. From tax certainty and litigation to customs duties, capital flows, even investors' confidence, he's truly advised governments and global corporations at the highest level. And therefore, there can be nobody better than him to understand and to break down for us what budget 2026 must deliver, not just in pure numbers, but also in credibility. And what will it really take in the upcoming financial document to make India, which is surrounded by a lot of macro uncertainties and geopolitical tensions and the changing world order, stand out. Mr. Mukesh Butani, welcome to the show. Thank you so much for taking the time out. I want to kickstart this conversation by understanding from you, looking at the context, that and the backdrop at which budget 2026 will be presented. How would you really look at this time around finance minister's focus to be? Will this budget be more about protecting the economy from such global shocks, or will it be towards accelerating India's long-term growth engine as its continuous focus?
I think the balance would be a pragmatic one. On one hand, India would like to protect itself from the global headwinds because of geopolitical risks and tariffs, while also on the other hand, we want to work with the Viksit Bharat, tagline for growth engine. Now, I don't think the choice here is an either-or situation, and it's about resilience and ambition, I would say, in the volatile world that we are living in. The India-EU trade signed today is a great opportune time. I think this will partly protect the economy from the shocks that we were experiencing out of the US deal. The US deal, hopefully, if it gets done, like many people speculate in the 3 months, that would certainly come as a bonus for India, fueling our growth even further. I think that the challenge is going to be on CapEx. If you just simply look at the CapEx figures, 12 lakh crore, is really the figure which is not matching with the capex from the private sector, and that would be, in my view, a big challenge. I think the other feature that you would see in this year's budget would be government's non-revenue sources of income, whether that's by way of dividends from RBI or public sector undertakings, and a little bit of divestment here and there. I think the policy would focus on the debt to GDP, which has seen a considerable fall. I think she's going to go in for a higher, lower the debt to GDP ratio in the next year or so. We could also see customs rationalization, introduction of the amnesty scheme, and the custom rationalization would largely be driven because of the spate of free trade agreements that we have signed. Bear in mind, since last year's budget, we signed with UK, today with EU, and then hopefully with the US in the next 3 to 4 months. So you need to have a completely different tariff structure to be able to deal with this bilateral FTAs.
Right. So on your customs duty policy expectation, should that be now driven more by export competitiveness rather than revenue protection? And if you could help us understand, can rationalizing import duties and fixing the current inverted duty structure, can that become the silent growth booster in this upcoming budget?
Addressing the inverted duty structure is a continuous process. It's all about experience. Last 3 years budget clearly is pointing out towards that. We need to see what the budget has in store. If there is a complete overhaul, some of the economists believe and liberals believe that we should considerably lower down customs duty on all raw material, barring few exceptions, and follow the reverse on the output, which means that you are encouraging domestic manufacturing in India. Domestic manufacturing is incentivized in a way because you pay lower tariff. I think the other aim also would be a seamless movement of intermediary goods and allowing Indian manufacturers and multinational manufacturers to move their value chain into India. You cannot achieve it without completely addressing the inverted duty structure. I think a balanced structure will help Indian manufacturers compete more effectively in the price sensitive global markets, which is experiencing reduced cost. So fixing the duty inverted duty structure is not a one time exercise. It is a significant exercise, and if the recommendations of the committee on rejigging customs is being implemented, you're looking at a fairly large overall of the customs structure in this year's budget.
Right. So there's also a massive shortfall as far as tax collections are concerned. GST cuts have led to that, slowing GDP also probably. How do you think the finance minister will ensure that her tax kitty remains buoyant and the capex is also taken care of at the same time?
See, let's divide the tax collection in two parts, GST and direct taxes. I think when the government took this major decision to overhaul the GST and charge less GST on certain products which are falling in the common man's basket, it was very clear that the collections will slow down. But I think the underlying assumption was the consumption will go up. And if the consumption goes up, you really are betting on the economies of the scale, and over a medium to long term period, it will go up. So far as the economy is delivering the growth, so far as consumption is rising, which is very evident if you look at automobiles and many sectors, I don't think that there is any need to worry about it. The blip, if any, was because of the rejig that we had. Of course, the rejig also happened just before Diwali. So Diwali's consumption goes up. So we have really not seen the impact, but we may actually see it in the last quarter of the fiscal year starting January. I don't think that that's a bigger worry. I think the bigger worry could be the fall in the direct tax collection. And again, you have to look at it whether you're talking about individuals or you're talking about large corporates. I think large corporates tax collection has fallen down to single digit. It is not very clear if it is because of excess refunds or actually there is a slowdown in the quarterly profitability figures as a result of which it is speaking up. But most people tend to do the catch up in the last installment of advance tax in March. So in my view, we should view this single digit growth on corporate tax collection with a pinch of salt, because you would really get to know the result in the March advance tax estimate. If at all we end the year with a single digit corporate tax collection, then I think we need deeper tax reforms. Well, one has already been implemented, which is the new income tax code, but we are yet to see the subordinate legislation. But there is a whole lot to be done to achieve efficiencies in the tax administration such that we are able to collect more taxes. But that's again a medium to long term objective and a series of reforms that are required, not on the legislation, but more on the administration.
Also, sir, do you see, should the budget 2026 also prioritize tax certainty over any further tax concessions, especially at a time when investors are valuing predictability more than the SOPs at this point? And also, if you could highlight, what is the single biggest unresolved tax ambiguity that Finance Minister must address this time?
Well, as a practitioner, that subject is close to my heart because we deal with it on a daily basis with our clients. I think that's the single most factor, the tax certainty part, which sometimes makes investors, particularly foreign investors, a little bit nervous about the situation. We need it. But, tax certainty is more a philosophical word. I mean, there are many facets to tax certainty. Do you achieve tax certainty by making sure that we respect double tax treaties? Do you have tax certainty by ensuring that there are no retrospective amendments? So there are many facets to tax certainty. It is not one size fits all approach. I think what we need really, and this is a point I was alluding to in the earlier
Hmm.
part, is deeper administrative reforms. A simple way to start would be that if a policy is legislated, let's say, for instance, a tax incentive, are these policies being implemented very well, efficiently? Is the enforcement mechanism for that policy looking into the eye and saying, yes, we are sticking to the policy intent and we are not getting necessarily bogged down with technicalities? Because if you promise an incentive to an investor and then on technicalities you refuse them the benefit, then the question of certainty comes up. So it is not a one area of certainty, but it's multiple areas. For example, let's look at sovereign wealth funds.
Yeah.
We've experienced a surge in sovereign wealth fund investments since 2020, and that, in my view, was a master stroke by the government. When it rolled out the tax incentives by saying all forms of passive income, capital gains, interest, dividends is not taxable. Then we extended it when it expired after 3 years. My simple proposition is, why extend it after 3 years? You go and make a policy intent that I'm going to give this incentive for the next 10 years, right? That is, in my view, certainty. Certainty is not about piecemeal implementation of reforms, it's the big ticket reforms. Though we had the policy of sovereign wealth funds since 2020, I think it took us about a year or two to stabilize the policy, prescribe the form, get into an approval, amend the act. No, bring out a policy that have a separate division within the income tax department that deals only with sovereign wealth fund investments. Take another example, the AI driven data centers, global value chain. Most of these players are wanting certainty on the taxation of non resident companies with whom the data centers would be dealing with. Give them that certainty. Let's make sure that we look at it very, very liberally, first to attract investment, and then make sure that that investment comes in after we give them certainty and the enforcement mechanism speaks to the policy. I think that, in my view, is key.
Is it the right time, in your viewpoint, to revisit the capital gains taxation now to bring stability, say, across asset classes? We've also been seeing how foreign money has, let go of India for a large part now, over 1.5 years odd. We have been at the receiving end there. What will bring back foreign money? Do you think there is a need that the government really pays attention to that aspect?
See, the rationalization of capital gains regime took place last year's budget. I think we have more or less rationalized capital gains tax rate across the class of assets as well as across the class of taxpayers. I think what the point that you make with regard to outflow of institutional money, that has got more to do with one, uh, you know, tax certainty, again, the point that you were making in the past. So, if you look at some of the current trends of judgments given by the judiciary, I think that has made many investors nervous, wherein the courts are trying to suggest that you need to look at tax treaty claims with the lens of anti tax evasion law, domestic. Now, this is where a lot of institutional investors in the last few days have got very nervous about it. I think they deserve certainty. Supreme Court has done what it has to do in terms of interpreting the law, whether we like it or not. That's the law of the land. But now that's an opportunity for the lawmakers to intervene and clarify. What do they need to clarify? They need to clarify we are not going to reopen the past assessments. India respects double tax treaty. The domestic law provides that treaty has an overriding factor, and it's only in those outlier situations that the GAR provisions will be invoked, that anti-avoidance provisions would be brought back. That, in my view, is the single most certainty attribute that we owe it to our institutional investors.
Okay. Let's also talk about FDIs then. I want to ask you, does India risk losing any manufacturing investments just due to the high effective import duties on inputs right now? We've been seeing over the last many years PLI schemes be, talked about in the budget speeches. Are PLI schemes really delivering enough bang for the buck, or do they need a rethink as well in the budget?
Well, PLI spreads across many segments of the manufacturing industry. The initiative has been of immense significance for the industrial sector. It has had challenges. One is, has PLI delivered on the promise of employment? I think the jury is out whether it has or not. But having said that, you must also remember that PLI has delivered enormously in certain sectors. For example, take mobile phone and electronics. They clearly stand out as beneficiaries. At US dollars 927 billion, electronics and electrical manufacturing, of which China commands 26%. I think what India needs to look at is what is the share of pie that it can grab. We've done well, but we still are not comparable to the kind of investments that China is making and the kind of industry turnover that they had. Despite all the skepticism, we shouldn't forget the fact that India has reached a smartphone exports of $18 billion dollars and in 2024, and in 2025 even higher. I'm not even factoring an Apple situation, because Apple
Yes.
is more a combination of PLI and the global value chain that has moved into India. So I think we do have an opportunity in white goods sector, IT hardware. This PLI schemes which are expiring very soon, I think they need to be looked at. Some industries do deserve continuity of the PLI, and some of them the government may actually discontinue. So overall, my view is PLI has been a important pillar of strength for certain segments of industry from a high skill employment and large scale investment standpoint. I am overall optimistic that PLI will continue to gain momentum, and we will land somewhere in many sectors where India will be able to achieve prominence. I think that what started off as the 14 sectors and got expanded would be restricted in the future. And there are some structural inefficiencies that are there in the PLI scheme. They need to be addressed, but we shouldn't forget that PLI indeed has developed. The government can look at some of the other industries such as AI, space, and robotics for the purposes of PLI, but it continues to hold good promise.
Okay. One more missing factor in the last couple of years has been what we've been seeing is that the absence of private capex, or it hasn't pulled up in a way that we would have loved it to. So far, the government has been really pulling up, you're doing the heavy lifting, but at this point in time, what will it take for private capex to really kickstart at this point?
I think you hit a very important point. Private investment has been low in general, and capex has also been low. I think the government's bet that it would step in the areas of infrastructure, and the industry will step in the areas of steel and cement has really not paid off. Figures speak for itself, but equally, if you look at it from a business standpoint, most companies are worried about the quarter to quarter results. So currently, the capex utilization in manufacturing stands at 75%, and hence, economics of a business do not justify fresh capex. So that's the view that the industry has been raising. I think that most experts are recommending raise the household income and savings, and through that consider more consumption, which will lead industries to manufacture and produce more, which means that they will run out of the current capex utilization that they have and look at new capex for long term investments. So I think we need to design some of our structures in that way. To some extent, last year's proposal to rejig the income tax rates, then reduce the GST on certain products which appeal to the common man, are a step in that direction. The question is that enough? We can also redesign policies to provide free and fair competition in certain areas. Certain businesses need fiscal incentives, because either because they are not able to compete in the global market. So look at incentives. Tax holidays and tax incentives are not necessary and evil as economists have been suggesting, because we need to tune our economic policies to suit what really are we looking at it.
Right. If you have to personally advise finance minister this time around, what is the one reform you would really push hardest for this time?
I would say deep-rooted tax administrative reforms. I think a lot can be done both to address the challenges that businesses, particularly small and medium enterprises, face, both from the income tax department and the GST department. I think we need to look at small and medium class taxpayers very differently than large taxpayers. I have been a huge supporter of the large taxpayer units, which started with so much fanfare way back in 2007, and it was discontinued. Bring back large taxpayer units, consider other taxpayers in a different category, scrutinize them less, but because they come under intense compliance burden. You need not have an enforcement mechanism either for GST or for income tax that views every taxpayer with a lens of suspicion. By all means, go ahead and investigate frauds. Frauds do happen, but they are outlier situations. Not everyone is fraudulent. India is by and large a rule abiding, compliant citizen and business that we have. So if you come across those situations of tax evasion, by all means, let the enforcement machinery take over. But don't paint all forms of taxpayers with the same brush. I would say that this is critical. I think we've achieved a lot insofar as the FTA is concerned, whether it's the European Free Trade, UK, New Zealand, EU. I think US will be much awaited. So there is no advice that I can give on the bilateral trade front. I think it's been a fantastic move by India. Yes, I think customs is something that we discussed. So I think these are the three key aspects in my view, which will go a long way to achieve our Viksit Bharat dream.
Fantastic. Thank you so much, Mr. Butani, for speaking to us, sparing your time, giving us these wonderful insights. And I do hope that the finance minister is listening and some of this definitely makes it into the final budget document. Thank you so much for taking the time out for Business Today.
Thank you for inviting me.
All right, viewers, that's the exclusive conversation with Mr. Mukesh Butani as to what could be this time around on the top agenda when Finance Minister presents the Union Budget of 2026. What is the need of the hour? What does the economy really need? And how Budget 2026 could truly be an opportunity for the Finance Minister and the government to present a roadmap towards Viksit Bharat 2047. Stay tuned with us. Much more coming up on your screens up next.